Hopefully you can all hear me, and many thanks for joining us this morning. Just want to take you through a couple of pieces of legislation which are due to come in, which are not new, but they are very relevant to companies' cash flow if you're in the construction sector. I'm going to introduce you first to Sue Rathmore, who's our VAT partner, who's going to talk about the construction reverse charge for VAT purposes. And then I will pass you on to John Harvey, who is one of our tax managers, who can take you through the off payroll workers legislation, commonly known as IR35, which is to be introduced soon for the private sector and very much affects the construction industry as well. So I'll pass you over to Sue. Thank you very much.
Thanks, Glenn. Just bear with me whilst I share my screen with you all. Great, there we go. So a very good morning, everybody. And a bit early this morning, but at least it's a lovely sunny day. And I'm going to take us through the changes that we're expecting to come in from the 1st of March this year, which will change the way that the construction sector accounts for VAT on its supplies. It's a big change, and you need to be ready for it because it's going to have some consequences that perhaps aren't quite so easy to foresee, and you need to be set up from point of view of invoicing, from your accounting, from dealing with your contractors and so on. So without further ado, let me go through. I'm going to start with why have we got this? So HMRC are saying that this is to combat a VAT fraud. I don't know if this is the case, but they are of the view that what is happening is in this chain between the workforce, the subcontractor, there would not normally be any VAT because they're employed, but the next link of the chain is where things are going wrong, and the subcontractor charges VAT to the main contractor currently. The main contractor is entitled to recover that as their input VAT, but the subcontractor doesn't pay that VAT to HMRC, presumably disappears with the VAT, and therefore HMRC is out of pocket. It's similar to the approach that HMRC have taken in other situations with mobile phones, computer chips and gold by introducing this change to the way that that the VAT is handled in order to avoid this situation where one part of the chain disappears, taking the VAT with them. So how will it work? So from the 1st of March 2021, and if you probably recall that this has been postponed twice now. It was due to be brought in September 19, and then it was postponed to September 20. And then just before that time, HMRC realised that we were all a bit tied up with COVID and Brexit, and therefore they decided to postpone it to the 1st of March. Now, obviously, there's no certainty that it will come in from the 1st of March 2021. We've still got COVID, we've still got Brexit to deal with. HMRC are still very much taken up with other things, but we have to prepare for it. You have to get ready for it. I'm afraid there's no alternative. It's not really a wait and see type thing. You're going to have to be ready. So let's have a look at what it means, and that is this situation for the subcontractor is where it changes. So if you're a subcontractor and you're billing a main contractor for your services, then you as the subcontractor, you don't charge VAT, but the main contractor pays the VAT under this new reverse charge and can recover it on the same VAT return. So pays it as output tax and then recovers it as input tax. The subcontractor charges no VAT at all. They just issue invoice without VAT, and we'll have a look at what that will look like. No change between the main contractor and the customer, the end customer. If VAT is chargeable, then VAT must be charged to the end customer. So no change at that point. The change is in this middle section. And of course, you might be a main contractor in one job, but you might be a subcontractor in another job and so on. So you need to know how it's going to work from both points of view. What's the scope? Well, the scope is basically everything where CIS applies. So all those services where payment has to be reported under CIS, the reverse charge will apply to those. So I've just put some examples there, but it's extremely wide. The only things it doesn't apply to really are architects, surveyors services, and as I mentioned before, where you are billing the end user. The legislation calls it the end user. We might refer to it more simply as your customer, your end customer, but it's the entity or the person that consumes that service that doesn't make an onward supply of it. So pretty much everything covered within the scope of the reverse charge. As I said, it doesn't apply to end user, and certain supplies connected with end users are also excluded. So if you're in a corporate group, then you don't use the reverse charge in those situations either. It's obviously, at times, it's not going to be obvious if you're billing the end user. Therefore, you need to know for certain. So what we're suggesting is that the onus is put on the customer to declare if they're the end user. And the suggestion is to make that a contractual condition. So put it within the contract. Yes, your customer is an end user, therefore the reverse charge won't apply and you'll charge VAT to them as usual. It doesn't apply between a landlord and a tenant or by a subcontractor to a landlord who will then on-supply the tenant. So can you see this is actually a lot more complicated than at first you would think. You've got to know what your part within that chain, but not only that, you've got to know what happens after your part within the chain. So it's quite complex really, and something that you need to be thinking about now and getting into contracts now in the run up to March, because we're only 4 months. Goodness, that's really close. It doesn't apply to suppliers within a VAT group. No surprise there, because we don't charge VAT within a VAT group. So if you're making supplies to another member of your VAT group, you don't use this reverse charge. And as I said before, it doesn't apply to supplies within a corporate group either. And that's defined within the law as to what a corporate group is. More of the detail. So within the construction sector, we have services that are liable to the 0 rate, to 5% reduced rate, and to the 20% rate. This reverse charge will apply to services that have the 5% and the 20% rate, but it's not applicable to the 0 rate. Kind of obvious because there's no VAT there. So there's nothing to reverse charge. But what this means is that obviously you've got to get the rate right as to what applies to the services that you're providing. If you're making a mixed supply of services and goods, so the reverse charge only applies to the supply of services, but if, for example, you're making a supply of services and also supplying goods at the same time, then rather than trying to carve out the services portion, you apply the reverse charge to the whole supply. That's what HMRC have said. So even though there's goods in there, you reverse charge the whole supply. And if you're supplying services that are specified services, so they are subject to the reverse charge, together with services that are not subject to the reverse charge, then you apply the reverse charge to the whole supply, except if the reverse charge element is less than 5% of the whole supply, then you don't apply the reverse charge. It's complicated, isn't it? Every single case you're going to have to look at to determine whether VAT is chargeable by you, or whether it's going to be reverse charged by your customer, or if you are the main contractor, is your supplier going to charge it to you, or are you going to have to reverse charge it? And just to remind you, no changes here to input VAT recovery. So if you're the main contractor and you are reverse charging, you're entitled to recover that VAT because you're paying it on that supply. It's your input VAT, so you're entitled to recover it, of course, subject to the normal rules, as long as you're not using it for some exempt supply, but you're entitled to recover it. So you would account for it in box 1 of your VAT return, and you would recover it in box 4 of your VAT return. If you're the subcontractor, then although you're no longer going to be charging any VAT to your customer, you're still entitled to recover the VAT on your costs. So there's no change there. You will continue to recover input VAT as you do now. It's just you won't have any output VAT to offset it against, which will create its own problem for you. I'll come back to that. Invoicing. So there will have to be changes to invoices made. So you might need to sort that out now to make sure that your system will allow you to change your invoices. So for invoicing, if you're the supplier, so let's say you're the subcontractor in my chain, then you must show all the information that you normally have to show on a VAT invoice. There's no change there. But you also have to add this wording. You have to show that the domestic reverse charge applies and that your customer is required to account for the VAT. And any of these words that I've put down here, you can put on your invoice. There's no legally required wording. So as long as you have some combination of these words here, reverse charge, and either the legal reference or customer to pay the VAT to HMRC, then that will be fine. But obviously that does have to go on your invoice, which means you've got to sort your software out to show it on there. In addition to that, it's not quite that simple, because you also have to show the amount of VAT that your contractor is going to have to declare under the reverse charge, but you don't show it as VAT itself that you're charging. So you would put that wording, reverse charge, VAT Act, etc. applies, and then underneath VAT amount payable and at 20% or 5%. So quite a change for you if you're the subcontractor. You've got to change your invoices in order to make sure that you are complying with the law. I will come back in a moment to the impact of all that on the main contractor and under their accounting records. But let's just have a quick look at this this flow chart, which helps determine whether you have to account for VAT as normal or whether it's going to be a reverse charge transaction. So starting in the top left, there are any of the supplies you're making within the scope of CIS. 5% disregard. As I said, if 5% or less of your supplies are within the scope of CIS, then you would say that the normal VAT rules apply, but more than 5%, the reverse charge will apply. So let's say yes. Question 2, is the supply standard rated or reduced rated? So if it's 0 rated, the answer is no. You go to the right, normal VAT rules apply, normal invoicing. But if the answer is yes, then is your customer VAT registered? If the answer is no, then you have to account for the VAT because they can't, they're not VAT registered. So you've got to know if your customer is VAT registered in all of this. So that's another piece of information that you have to collect. The answer is yes, is your customer CIS registered? If the answer is no, you have to account for the VAT. If the answer is yes, then you continue down. Has your customer provided written end user confirmation? So that's your customer saying, no, I am the end user, you charge me normal VAT. If they haven't told you that, then the reverse charge applies and you won't charge any VAT, you will expect your customer to charge it. So it's a complicated way through, and you need to think through this flowchart for each of the supplies that you're making in order to get it right. So as I said before, it applies from the 1st of March, we think. That's what we have to work toward at the moment. No transitional period has been announced, so we go straight into it. That means that we have we have to work out what applies to supplies that you're making around that time, around March 21, beginning of March, so that you make sure that you get it right. So if, let's say you issue a request for payment before the 1st of March 2021, and you're paid before the 1st of March 2021, then the normal rules will apply because the payment creates its own tax point. But if you issue a request for payment before the 1st of March, but you're not paid until after the 1st of March, then the new rules will apply. So you could issue your request for payment under the normal rules, the old rules, but actually you should issue your invoice under the new rules so that the reverse charge can apply. That's going to be messy, isn't it? Pretty messy. Rules for self-billed invoices. So if you're involved in self-billing and authenticated receipts, I haven't got time to go through those today because we haven't really got enough time, but there are special rules for those and you need to understand those. So get in touch if you're involved in those situations, those special situations. So HM Revenue and Customs, they have said that there will be a light touch in inverted commas for the first 6 months. They haven't said what that means. So we can only hope it means that, if they find an error, that they won't apply penalties. That's what our expectation is. So you would have to pay the VAT or pay back the VAT, but hopefully no errors. No penalties, sorry, if you make an error. So let's have a think about how this impacts, practically speaking. So for the subcontractor, now, if you're the subcontractor, don't forget that means that you previously were charging VAT, which you would then pay over to HMRC maybe 3 months later. Now you're not going to be charging any VAT. So what that means is your cash flow is going to be very adversely affected by this. You don't have that VAT in your cash flow to use until you pay it over to HMRC 2-3 months later. So think about how you are going to be able to fund purchases if currently you're using the VAT to do that. Consider switching to monthly VAT returns. So that means that if you're currently doing quarterly returns, you would just file a VAT return every month, which at least means that you're getting back the input VAT that you're entitled to recover more frequently. Obviously, you're having to do a return every month, though, so you've got to weigh up whether it's worthwhile. System changes, as I said, your invoicing needs to change. Your account staff need to understand, so they need to be trained on this new system. They need to understand how they identify whether their customer is an end user or not. They need to understand when to issue the invoice under the new system or under the old system. They need to understand about tax points and how that impacts on when these new rules begin. So get your staff ready, get your invoicing ready, your system changes done so that you're ready from the 1st of March. You need to agree as well with your customer. What happens if there's a change of status mid-contract? This does happen, like the invoicing changes partway through the contract. Really, you need something in your contract that says they have to tell you if that's happened so that you can reassess, so that you can tell whether you're going to account for the VAT or whether it's going to be reverse charged. Mixed supplies I've talked about in the 5% disregard there. Amend standard contract terms. Do you need to amend your contract with your customer? Adverse cash flow position I mentioned. If you're using the flat rate scheme, if you're a subcontractor who's using the flat rate scheme, that's a special VAT scheme where you just pay over to HMRC a percentage of your supplies, rather than output VAT minus input VAT. You must come off it. You will be in a very poor position if you continue using the flat rate scheme, because you'll be paying VAT that your customer's not going to pay you. Okay, so get out of the flat rate scheme. If in doubt, if the recipient is VAT registered, the payments are subject to CIS, they haven't told you that they're an end user, then you need to apply the reverse charge. Okay. For the main contractor, again, the same thing applies. System changes. You need to be able to recognize as invoices come in that these are invoices that you need to reverse charge. So again, your staff need to be trained, ready to be able to recognise this special situation. They need to be able to deal with self-billing. So you raise the invoice on behalf of your contractor. In that situation, you've got to know exactly the contractor's position, your position, so that you know whether to charge VAT on that invoice or not. You need to identify the status of your customer are you effectively a subcontractor within the chain, or are you billing the end user? You need your end user to provide you with a written confirmation. And again, as I said, change your status mid-contract. Make sure you know that you'll be going to be told if that happens. You will have, as a main contractor, you will have a better cash flow position because you are the one who is going to be accounting for it on your return. So therefore, you're not paying VAT to your subcontractor and then waiting for 3 months to be able to recover that from HMRC. So you've got the opposite position to your subcontractor. But what you have got is a load of subcontractors who might well go bust. So you need to be aware of that, and probably talking to them about whether they will need any kind of financing. And there is financing out there available, loans, and to assist with cash flow. So talk to your subcontractors, make sure they understand how things are going to change, not just in the invoicing and the systems changes, but also the fact that they may find that they're in a very difficult cash flow position, and are they ready for that? So that really was a massive gallop through. Sorry to go through it so quickly, but we don't have a huge amount of time. So very quick gallop through. Are there any questions, Glenn? Did any questions come through whilst I was talking?
No, I don't think so. And I think time is a sort of a factor now. So I'm wondering if we should crack on with John.
Yeah, go ahead. So if I stop share, there we go.
Okay, thanks very much, Sue. That was brilliant. I'm just going to start sharing my screen now with everyone. So bear with me while I get that set up. Okay. So I'm going to be walking everyone through the changes to the off-payroll working, and this is going to be impacting the private sector. And let's get right into it. So time is a factor, so I'm going to go through this as quickly as I can, but also as comprehensively as I can within the time allowing. So I'm going to start off with a brief history of where IR35 came from and why it was there. So IR35 is the name that's been given to this piece of legislation, which has been around for a considerable amount of time now. So it's been around almost 20 years. And before this was introduced, what the revenue were trying to tackle here was because you could, I take as an example of myself, could be working for MHA up until a Friday. Over the weekend, I could then set myself up a limited company. And on the Monday, I could start invoicing my services that I perform for MHA through my company. And the reason why I might want to do that is because I could take out profits that I'd be earning in a much more tax efficient manner. So rather than being taxed as an employee, I could then have all of the income come into my company, and I could take that out in the way of a dividend, which, if we look at the current rates that we have for that, salary is taxed at 20% minimum if you're a basic rate taxpayer, or upwards of 45% if you're an additional rate taxpayer earning over 150,000. The national insurance rates are also more onerous, so they are 12% in the basic rate threshold, and then they drop down to 2% thereafter. Whereas dividends, that's only subject to income tax, and currently at 10% if you're in the basic rate threshold, jumping up to 32.5 and then 38.1. So there would be tax savings there that you could make. Now, the problem with this legislation and what the revenue don't like about it is the fact that it's never been as effective as they thought. Now, over a 6-year period, only £9.2 million of extra tax revenue was raised through this piece of legislation. which is only 1% of what they actually anticipated was the avoidance that's going through. And so they've been looking to make changes to this particular area. And 3 years ago now, we saw the introduction of the off-payroll working rules to the public sector. Now, this affected everyone in the public sector. And as you can see there with those figures, in the first 10 months or just 10 months of that being in place, an extra £400 million of tax revenue was built up and almost 60,000 of additional workers introduced to the payroll. So a big change, and it brought in a lot more revenue for HMRC. But moving on from that, what I wanted to talk about is what is IR35? Well, effectively, you need to consider the hypothetical contract. So if we jump back to my example where I was previously working for MHA up until a Friday, and then over the weekend I then set up a company and started invoicing through that on the Monday. Well, what you need to do for IR35 is actually consider the contract that would exist between MHA and my limited or myself, ignoring the company that I inserted in between that contract. And you would need to consider whether or not I, ignoring that limited company, would be treated as an employee or genuinely self-employed. Now, in order to determine that, there's a huge amount of case law that's been built up, and what we've seen from those pieces of case law and cases is that there's key indicators of self-employment. So you have, first off, right of substitution. If you have that, then you probably stand a good chance of being treated as a self-employed worker. But it's not just good enough to have a substitution clause in your contract. The revenue would look past that and think about what the actual reality is. So if there is a right of substitution in the contract, but it's something that actually in reality wouldn't be accepted between the end user and yourself, they would only want you doing the work, well, that's probably not going to stand up and be good enough. You also can look at control. And so if you have freedom to do the work in your own way, to your own time scale, and you choose your own working hours, and you're not directly supervised, well, that gives an indication of self-employment, and it's quite a good one. The last one, mutuality of obligation. So this relates to things like the concept here is the end user, the client, then has an obligation to provide you with work, and you have the obligation to then fulfill that work. So if you have that mutuality of obligation there, then that's probably going to be an indication that you're actually an employee if that contract is going to be lasting. But if that doesn't exist, well, you're probably going to be self-employed. The other indicators that we normally look at are things like if you as a worker and your personal service company have a number of contracts that you've got going on, that's an indicator in itself, but a very strong one, because what you're aiming to do in these scenarios is build up a big picture, and then you look at the eventuality there once you've looked at all of the different aspects that are going on. The other points there, the degree of integration, that would be things like you having an office or a laptop, or you're provided with equipment, and you might even have a business card. If you've got a direct line and an email address for the end client and that you're doing work for, that's going to be indicating that you might be an employee. So to the outside world, you look like you're part of the organization that you're working for, you're most likely going to be treated as an employee in that regard. So what are we looking at now? So currently the rules say, well, the client or the end user and the fee payer, they are not affected by these rules at the moment, because it's down to your company, your personal service company, to look at whether or not these rules apply. And so you would consider whether or not you would be an employee, and if you are, you then have to operate a deemed employment payment at the end of the tax year. So you look at all of your relevant engagements where you think this might apply, and you're allowed to deduct certain things, so one of which is a standard 5%. You can also deduct off the amounts you're receiving, things like travel or pension contributions, and then you look at the net assessable amount. And on that net assessable amount, you need to deduct income tax and employee national insurance under the pay-as-you-earn system, but you also have to pay employers' national insurance contributions, which can be costly at 13.8% on the value of those services. What's happening from April, and this is the major change that's going to be happening, is there's going to be a switch of who has the responsibility to determine whether or not you're employed or self-employed. And that determination has to be provided to not only the worker that you're engaging directly, but also it has to be passed down the contractual chain. So if you, as an end user, have an agency that you contract with, and that agency then gathers workers, and some of those workers are using a company as an intermediary, well, that decision has to be cascaded down that supply chain. The determination itself would have to include reasons behind the decision that's been made. So that would have to give things like why you've actually made that decision and the factors behind it. Once the worker has received that determination, they actually have the opportunity to appeal against it, and that is made towards the end user, the one that's made the determination, and they have a responsibility under the legislation to actually take that on board, review it, and then respond within 45 days. Now, at the end of that 45 days, two things would have happened. Either one, they've kept to the decision and reissued it, or two, it's the appeal's been upheld and the status changes. Now, if the rules do apply and the worker that you've engaged would actually be treated as an employee, ignoring all the contractual chain in between, then pay as you earn must be deducted, and that's deducted by the fee payer. It's paid over to HMRC, and that liability for pay as you earn will cascade down the supply chain as each party fulfills its obligations. And to illustrate that, it's best doing this example here. So as you can see, you've got the client on the far left. That's the end user, the one that's using the services of the worker. The determination is provided to the worker themselves and then down that supply chain there. So the client's obligations are to provide a determination to the agency one. And then once it's done that, it's fulfilled its obligations. So the pay-as-you-earn liability would transfer down to agency one. Agency one then has to provide that determination to the fee payer, i.e. agency two. And once it's done that, it's also fulfilled its obligations, and the liability then transfers down to the fee payer themselves. So the fee payer will then withhold pay as you earn, income tax and national insurance, and provide a P60 to the worker, and that's effectively how it would work. So who will this be affecting? Well, it's only going to be affecting large and medium-sized entities. Now, what do I mean by that? So for corporate entities, the rules will apply where you can meet any two of the following conditions. The first is £10.2 million of turnover, 5.1 balance sheet is a second condition, and lastly, more than 50 employees. If you meet any two of those, you're going to be large or medium-sized. Small entities above there, as you can see, are exempt. But for non-corporate entities, it's only a turnover test, so for partnerships, things like that. And you're only looking at that £10.2 million of turnover only. So how can you prepare for this? Well, the first thing that I would be encouraging you to do is review your existing engagements. So if you're the worker, you want to be looking at who you're working for and hopefully you're going to be receiving determinations from April 2021. If you're the end user or an agency in the supply chain, you need to identify where you sit. And if you are the end user, the client, you need to be looking at those engagements that you have and then providing status determinations to all of the workers that might be affected. And this would be requiring you to look at the contracts, both the actual written word and how the workers are actually operating for you. And there is a tool that the revenue have provided to everyone. There's been a couple of iterations of it. The latest one is not too bad, but it's also not the best. So I would be putting all of the affected workers through that tool. It's called the Check Employment Status for Tax, so CEST. And if you Google that, it will come up with a link. Equally, I can supply that to you if you need it. And effectively, that will run you through the different tests for employment status. And it will come out with a result at the end, which you can then print out, and that can be supplied to the worker along with your determination. It would also require you to look at your internal systems as well, because you need to make sure that from April 2021 you are compliant with these new rules. So that might involve updating your engagement process, how you take on these workers, and it might be worthwhile looking at adapting the new starter checklist that you might have for ordinary employees and incorporating the off-payroll workers element in there. Because in order to operate pay-as-you-earn, you're going to need various pieces of information in order to do that if you're the fee payer. And it might be an idea to estimate the potential costs involved here, because with the employer's national insurance contributions, that's going to put an additional element of cost into the contract, and you might want to consider potentially amending fee rates if there's scope to do so, to incorporate the additional administrative burden as well as the additional pay-as-you-earn that might be due. So that was a very quick run through. I did blast through that. If you do have any questions about it, do lift the phone to us. I'm more than happy to talk you through and help you prepare for the changes that are coming in from April 21. Thank you very much.